Hello and welcome to the second video of our series, Healthy Trading Habits. Today's video is called the 10-second test. Before we get started, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. With that said and done, my name is Justin Paolini, Head of Trader Development here at FCI Markets. But the one thing you need to know about FCI Markets is that we want to give you the tools to become a consistent trader. We want to help you simplify your trading habits, and we want to train you and expand our trading desk in the UK or remotely, bring on board promising traders that can demonstrate a prowess in trading the markets. Now that brings us to today's video on the 10-second test. What we are trying to do with this series of videos is to give you some decent trading habits to follow that will put you ahead of the herd. Now, one of the worst habits that I see time and time again is the tendency for traders to fight established trends. So in today's video, we're going to understand how to face the right direction and not fight an established trend, as you see here, where traders were net long as price was declining, and then they switched to net short as the trend was steadily changing and moving up. One reason I believe that keeps traders on the wrong side of the market is that they try to trade what they think instead of trading what's in front of them. These are simply two images I took from a very popular social trading site, and they're both calling for something that has yet to happen. They are both analysis talking about declines in instruments that are still evidently trending up. And this, I think, is one of the main reasons why a lot of traders get into trouble. They try to trade what they think will happen instead of following the flow of what actually is happening. And this leads to the bad habits like calling tops and bottoms or trying to fight an established move instead of following it. Another bad habit that I've seen is the tendency to zoom in. I would suggest that you do not zoom into your charts like this, but instead you zoom out. And on a daily chart, see anywhere from 6 to 9 months of data so that you can see at a bird's eye view where the market is actually going instead of getting caught up in the details. So let's talk about this 10-second test. The concept is very simple. If the market is doing something interesting, you should be able to see it within 10 seconds of opening the chart. So right now, just tell me within 10 seconds of seeing this chart, which is dollar-yen at the time of recording this video, where are we going? Okay, if it took you 10 seconds to see this, then you might have to go back and review some more basic stuff, because this chart is not going anywhere. This chart is not interesting. Dollar-yen is something that you should not be trading at the moment, and it's something that is best left alone. Now vice versa. Where are we going here? Give yourself 10 seconds, and if you can't answer, go back and review the basics. This is evidently an uptrend. There should be no question about it. And we are also not interested in catching tops. As long as the uptrend is valid, we shall remain dip buyers. Here's another chart on gold at the time of recording this video. There should be no doubt that this is a clear uptrend. So what exactly is a trend, and when does a trend become evident? Mathematically speaking, but also visually speaking, a trend is nothing more than price breaking out of a range. That's when it becomes really evident. I've drawn lines at monthly highs, which is usually where these retracements start from, and as you can see, they are the places where the trend evidently looks like it's going somewhere again. A top is made, a retracement starts, and the market looks somewhat lateral and range bound until it actually breaks through again and continues on its merry way. And the same thing up here. I've drawn the highs as the market pulled back and continued to pull back from that cycle high until finally it breaks through and continues. And then the same action happens again. It pulls back until finally it breaks through. So trend is price breakout. What we are trying to do as traders is to be a bit smarter and not capture price just as it is breaking out, because that is a bit too evident. That's something where everybody will be involved. A mix of orders and agendas will be in the market at that level. So what we're going to do is we're going to try and play a pullback, for example, once the trend is established, or use a combination of time frames to get into the market once the trend is established. There is no rush. And this is one other thing that keeps traders constantly going around in circles instead of being constant earners. Being disciplined in following an approach that keeps you on the right side of a trend, using, for example, a combination of time frames to play that trend so long as the market is moving in line with that trend. So one final example here in using that 10-second test is to use it for entries as well. What I've done here is I've simply zoomed into a 1-hour chart of New Zealand dollar when it was actually breaking out of that first initial line. So let me go back. When it's breaking out through here, I'm going to zoom in onto the hourly chart to see how an evident entry could have helped you get into this initial trending move up. So all we're going to focus on are key price behavior candlesticks, the ones that everybody can see and everybody can recognize. Spinning tops, dojis, inside bars, outside bars. And we're only going to focus on these bars when price is pulling back, because the idea is to get in the market before price starts to push in line with the trend again. And all I've done is I've highlighted them. Only the most evident ones that really stood out without having to look too hard. There we are. And again, an engulfing. Neutral candle. Inside bar. An inside-outside combination. These are evident candles that happen during pullbacks that don't require anything more than 10 seconds of studying your chart to see. Coming closer to today's action, we have some more of these simple entries. Again, inside bar, another neutral bar, and again, an engulfing. Neutral bar, an engulfing. Pin bar. These are very simple. You don't have to study your chart or make it any more complex than this. We know the market is trending upwards, and so all we need to do is identify our triggers of choice on a smaller time frame to take advantage of that upwards momentum. I hope this video was simple enough, because the idea is to keep things simple and not overcomplicate your trading. But if you need further guidance, the first thing I would suggest that you do is subscribe to our Thought Leadership blog. Just go down to our blog, click on subscribe, insert your details, and you'll receive all the analysis and thought leadership pieces that I produce. The second thing to do is to follow the FCI Markets Twitter feed at FCI Ltd UK. On our Twitter feed, we only post the most relevant market information each day and some chart analysis. Finally, if you want to make the transition from being a profitable retail trader to being a professional trader and get funded, then come on over to our Trading Academy. This is where I teach you a proven method used by professionals and myself to trade the markets. And we are always looking for talented traders to join us on our desks in the UK. If you have any final questions, just get in touch. We're happy to hear from you. Write to us at clientsupport@fcimarkets.co.uk. Give us a call, or even come and visit us if you're located in the UK. I look forward to hearing from you, and I wish you the best in your trading.